We're back on Morning Movers. Here's Broadcom. Other chip names moving higher this morning after Alphabet raises 2025 CapEx estimates from $75 billion to $85 billion as AI and cloud continue to drive expansion. Broadcom currently a chip supplier for Google phones, data centers, and AI. That stock is up more than 70% over the last 12 months. Time now for Options Corner. Joining us for a deeper look at Broadcom is our very own Rick Ducat, lead market technician. All right, let's talk about this chart for Broadcom. Some argue that it should be a member of the Mag 7. What trends are you noticing for this one?
Yeah, perhaps not a household name, but definitely up there in terms of market cap and also how strong it's been during the past year, up 87%, really just kind of blowing away the sector and the S&P in general. But if we were to take a look at our candle chart more closely here, we can see that after we had this push above the 250 level, our green line here representing these old highs and this volume node, price has pushed to the upside, mostly held on around that supportive area, now rising once again in this wedge type shape here, topping out near 290.50. That's about the point of our +1 standard deviation channel, and that's about where you might expect to find potential resistance. If you were looking for more support, 21-day EMA lines up with another volume node near 274. Beyond that, the 250 level, other indicators come into confluence there.
All right, and then Rick, what are you noticing in terms of volume or recent options activity for Broadcom?
Yeah, pretty active name in general. Yesterday's volume, mostly between 270 to 310 in terms of strikes. Heavy trading as far out as January 2026, though. We'll focus on August 15th expiration, though, for the open interest. Other high months, September, December, January. But August 15th, about 13% of the total open interest, coming in at like 166K. In terms of the general range here, we can see that the call side 250 to 320 versus our expiration expected move of 259 to 322, largely in line there, kind of pretty much matching up with those boundaries here. But we can see for the put side, much more dispersed, much lower. 160 to 270 is the range, 220 is the highest. One interesting opening trade, selling 1900 September 19th 270 puts, about a $3 million credit received on this neutral to bullish play.
All right, thank you, Rick. That's our Rick Ducat, lead market technician, excuse me. All right, that was a tongue twister there. Now take us through an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. All right, Tom, what's the approach for an example trade for Broadcom, especially since it's clearly got a tailwind from this move from Alphabet Google?
Yeah, you got to remember that Google Alphabet, doesn't exclusively use Broadcom, but they are a big supplier for them, more than NVIDIA and some of the other players in this spot. The stock is just below all-time highs. It's rallying up to about $288 a share this morning. Implied volatility levels really low in this name. The IVGO percentile rank below 20% level, so we're in the bottom 1/5 of what we've seen implied volatility levels over the past 52 weeks. So I looked at a strategy. If you think the stock's going to continue to move to the upside, this takes advantage of it, and it takes advantage of low implied volatility moves on this one. Went out to the August 15th monthly option series, so 22 days to expiration. They don't report earnings until the 4th of September, so you avoid that earnings event while still taking advantage of upside if you think it's moving higher. By the slightly out of the money 290 call, the stock's going to open up around $288 a share. So buy the 290 strike call, and then against it, because we want to offset some of the costs and risks on this bullish call purchase, sell the 310 strike call. So a bullish $20 wide call vertical. You're paying roughly about a $7 debit for that if the stock opens up right here. So that's your risk, $700 per spread. But that spread can expand to $20. So you've got a good risk reward setup. It takes your break even up to $297 to the upside. That's less than 3% above the current share price. So it's not like you need a monster move to the upside. Now, why do you sell that 310 call against the long 290 strike? Well, on a percentage basis, what are the expectations or probabilities that AVGO is going to hit 310 before expiration in the next 3 weeks? Well, it's less than 40% at this point. So the odds aren't good that it's going to go above 310 at this point. So maybe selling that call against your long 290 strike call makes sense in this type of trade. As I mentioned, the risk at $7, your break even $297 to the upside. You don't need that big of a move. It takes advantage of upside, and you're paying less because the implied volatility levels are lower, so option premium has contracted a little bit, and that makes this bullish call vertical a little bit cheaper.
All right, and once again, that's an example trade there for Broadcom, who many argue should be a member of the Mag 7 or Mag 7 Plus. Thank you, Tom.